So you bought a house and you're ready to go ahead and sell the house. And you're like, hey, we've been here a year, we like it, but like we need to upsize. My advice to you as an agent is gonna be, hey, hold on to the house for another year. And the reason is when you purchase a home, the clock starts on capital gains tax. From the day you purchase a home until the day 2 years later is when the government can charge you capital gains tax for selling that house. And it's short-term capital gains, so it's not an expensive capital gains. And you won't know about it until you come around to tax season. So if you sold your house May of 2024, you wouldn't know until April of 25 that you owed this capital gains tax. So if you own your house for less than 2 years, unless we can break even and literally not make you any money, and there is huge circumstances like job change, sickness, that kind of thing, my advice to you would be to hold on to that house until you hit that 2-year mark. And when I say 2-year mark, if you want to close the day after 2 years, that's fine. We can close the day after 2 years, but don't close before it, because if that house has made any money and you see some of that money, then you're going to be charged capital gains tax on it. And a lot of houses in the past couple of years have made money like that in the past, in 2 years versus having to wait 2 to 5 to 7 years to sell to break even. We're seeing a lot of people be able to sell and make money off of that, which they're super excited about and they want to move up to the next house. But the last thing I want is for come tax time you to be slammed with this huge tax bill because you sold your house and you made money and the government said, pay me. So once you hit that 2-year mark, capital gains tax goes away up to a certain amount. If you are single, you can make up to $250,000 on your house and not pay capital gains tax. If you are married, you can make up to $500,000 on your house and not pay capital gains tax. And that is what you sold your house for, minus what you bought your house for, minus any improvements that you actually still have the receipts for. That is what they're going to use. That bottom line number is what they're going to use to say this is whether you owe capital gains. So if you're doing improvements to your house, if you're putting a roof on, if you're putting floors in, if you're putting dang new outlets in, whatever you're doing, keep the receipts. Because if you live in your house long term, like a lot of boomers are right now, they're seeing that they have these huge capital gains that they have to pay, that if they kept all the receipts of what they did to the house, they may not have to pay them. And it's no longer where if you roll your house from one house to the other, you skip that capital gains as your primary residence. That's a totally different thing for an investor. It's called a 1031 exchange. It does not apply here in your primary residence. So like I said, own your house for 2 years. After 2 years, if you're single, you can make up to $250,000 on your house without having to pay capital gains. If you're married, $500,000. And so if you're in any of those boats, give me a call. I can get you with a tax guy that can walk you through what needs to happen so that you know what you need to save. If you're thinking about, selling and you want to know, am I in any of those boats? Give me a call. Love to help you and see what you would make off your house. I do a net sheet for everybody I talk to, and it tells you what you'd walk away with, and that'll tell you, hey, yeah, we're going to make more than that, or no, we're not going to make more than that. So don't forget to like and subscribe.